Are we technically in a bear market? Like, what would break?
And that's an example of something breaking.
So let's talk a little bit more about the market sell-off and the bigger macro picture, because your main newsletter focused on the Fed sort of being in this position of trying to tighten because they really need to, but trying not to spark a recession.
Yes.
So can you talk a little bit about what you're seeing right now and where you think this is going to go, and maybe how it's going to play out in 3 to 6 months?
So historically, the Fed tries to tighten when inflation's running above their targets and when the economy is doing pretty well. And then if the economy is weak and it's disinflationary, them and then also the fiscal authorities can collectively print money and basically reinflate things and ease monetary conditions. And the challenge to that model is when you have stagflation, which is you have high inflation, but also you have economic indicators weakening. Not the main ones like unemployment yet, because those operate on a lag, but kind of the leading indicators are already weakening. So this is actually a point where they would normally kind of already have been tightening and have now maybe would stop tightening, and they're just starting to tighten.
Yeah.
And if you look back in history, kind of these gigantic regime changes in policy happen when you have inflation, but then due to so much debt in the system, you can't tighten as much as you'd want to, that you maybe need to. And so I think ultimately that's what's going to happen, that they're going to try to tighten until something doesn't work out, something breaks in markets, or we enter a persistent recession, and they're forced to maybe stop tightening even when inflation's still hot. And I think that's kind of the quote-unquote end game of this kind of structural cycle, where they're just unable to tighten despite high inflation.
So I've heard you say that before, and some other macro analysts as well, that idea of something breaking in the system. Can you kind of define what that means or offer an example? Like, what would break? So
2 examples. One was late 2018, when we had that market sell-off with the Fed tightening. They were talking about being on autopilot. And then there's the famous Powell pivot, where they stopped tightening. And that a lot of people thought it's because of the S&P 500 being down 20%, but really it's because credit markets froze. So no junk bonds were issued for 6 weeks in the United States. The whole market just froze. And that's a more serious problem than just stocks being down 20%. And so that kind of forced them to stop, because it was basically the market became illiquid. And so they had to stop. And then less than a year later, in kind of autumn 2019, they had the repo rate spike. So they were still trying, they stopped raising rates. They were already cutting rates by that point, but they were still trying to tighten their balance sheet. They were shrinking their balance sheet, and they had to suddenly reverse course into quantitative easing because basically the banking system ran out of just excess liquidity. And so repo rates spiked. They had to come in and reliquify it, and that's an example of something breaking. So generally that refers to either a recession forming, or if it's financial markets specifically, it's credit markets, treasury markets, interbank lending markets, something like that just stops functioning and runs into a liquidity problem and seizes up. And then they're forced to basically reliquify it, even though inflation might be hotter than their target.
Are we technically in a bear market?
Well, bear market's generally defined as 20% downturn, which is arbitrary. So, but clearly we are. If you look at, especially under the surface of the indices, I mean, there are stocks down 50, 60, 70, 80, 90% in some cases. And then in addition, if you look at a 60-40 portfolio, like most of these other stock sell-offs in history came with bonds doing pretty well. But this one actually, bonds and stocks sold off together. So it actually hit people's kind of diversified holdings as much as a bigger stock sell-off normally would have. So I would say by most standards, yes, we're in a pretty significant bear market here.
In realistic terms, what's the best case scenario with what the Fed is trying to accomplish, and what's the worst case, but in realistic terms?
I think it depends on what timeline you're looking over. I think the best case is that you get kind of what happened after 2001, where you had the dot-com bubble collapse, and then you never really had a severe financial crisis. You just had a recession, and then you kind of continued from there. But I think situation's a lot worse than that now because of how much debt's in the system and because of where we are in the commodity cycle. So I think the more likely outcome is that this decade is going to spend a lot of its time being somewhat stagflationary, where commodity prices are persistently elevated. Now they can cool off for periods of time when we have economic contractions, but I think overall there's just not a lot of investment in oil, gas, copper, nickel, and then when you add geopolitical situations, some of the resources now cut off, or at least they're politically challenging to use now, and so we have to figure out other places to get those resources. And so I think that this whole decade is going to be kind of a struggle to keep getting the commodities we need, and that basically pressures economies and inflation throughout the world.
Some people are predicting a meltdown because they say that the Fed always pivots, the Fed has to print. That's the conclusion, everyone sort of has made based on history. Do you think that that's realistic to predict?